Good afternoon, Scan fam. We are back with another episode of the Crypto Club. We are on episode 17 here with Gons as always.
Hello, hello.
It's been quite the fluster in the cryptocurrency markets the last few weeks. I'm sure you've all heard about FTX, all sorts of headwinds we are dealing with. Really, week after week, it doesn't seem like things can get much worse. And the next thing you know, it suddenly gets much worse. So we'll see what happens in the following weeks, but we're going to talk about what's been going on here today. Now, starting off the episode, here on the CoinScan website, you can get a little sneak peek of something that we are soon to be coming out with, a little updated homepage. So make sure you're keeping an eye out for that. This is currently not deployed, just a little snippet for the scan fam. Taking a quick look at the overall crypto markets. Today, ETH is up around 3.8%. Bitcoin lagging a bit behind at 2%. Still just kind of crabbing in this range here with no clear direction. But we're already down at 1200s from a high of just below 5,000. So whether you believe in crypto long term or don't is really the question of where you want to buy. We are quite far down from our all-time highs. But if you believe in crypto long term, whether you buy at 1278 or you buy at 900 or you buy at 4,000, it doesn't matter so much over the long term. All right, so we'll go ahead and get on with our first story here. So the Senate committee is to subpoena FTX's Sam Bankman-Fried if he does not testify voluntarily. The Senate Banking and House Financial Services committees are holding hearings on FTX's collapse next week. So recently, CNBC said that one of the representatives up in the U.S. financial sector did not want to subpoena FTX. FTX's Sam Bankman-Fried, which was quickly rebutted by that person they alleged against, saying that they were not opposed to that. So the Senate Banking Committee wants Sam Bankman-Fried to appear before next week in person to discuss the collapse of FTX and will subpoena him if he does not appear voluntarily, a letter from its leaders said Wednesday. Senators Sherrod Brown and Pat Toomey, respectively, the chair and ranking member of the committee, wrote a public letter to Bankman-Fried, who resigned from the exchange the same day it filed for bankruptcy protection last month. The committee is holding a hearing on Wednesday, December 14th, a day after the House Financial Services Committee holds its own hearing on the exchange. FTX's collapse has caused real financial harm to consumers, and effects have spilled over into other parts of the crypto industry. The American people need answers about Sam Bankman-Fried's misconduct at FTX, the lawmaker said in a prepared statement. The committee has requested that he testify at our upcoming hearing on FTX's collapse and will consider further action if he does not comply. Normally, witnesses appear voluntarily, the lawmaker said in the letter. If Bankman-Fried does not confirm his participation by Thursday, I am prepared, along with ranking member Pat Toomey, to issue a subpoena to compel your testimony, the letter signed by Brown said. I think that is a great move. If Sam Bankman-Fried was not subpoenaed to appear in a court over the whole FTX situation, I think that would be a tragedy, not just for crypto, but just in the public's sentiment on, governments, right? Like we all know, SBF made large donations to some very powerful people, and a lot of people speculated, that SBF would see, repercussions for this whole situation because of those donations essentially paying off those powerful people. And now, of course, SBF is not indicted yet, and that's still a possible future. But if they are threatening to subpoena him, if he does not voluntarily appear, I think that's definitely a step in the direction people want to see.
Yeah, it's justice. I mean, it's great because, a lot of people didn't speculate because of those donations that he made that, he would face any repercussions. He was one of the biggest donators to the Democratic Party. He claims that he also made equivalent donations to the Republican Party, but secretly. And whether you believe him or not is up to you. But at the end of the day, it's, we already have Do Kwon on the run. He's at this point, it's been so long since the Terra Luna, situation. I don't think he's really gonna serve any justice anytime soon, which that in itself is a little disheartening. But at least FTX is going to, or Sam Bankman-Fried is gonna, face some responsibility and accountability for what he did.
Yeah, or at least it seems that way, right? Like he's being subpoenaed. There's also some other probes into, they call it like dark donations or something of that matter. Pretty much hidden donations to certain people, and we'll see if that probe actually digs up anything in particular. It's also worth noting that recently SBF said he had $100,000 to his name. However, somehow he has enough funds to hire Ghislaine Maxwell's lawyer. And for those that don't know, Ghislaine Maxwell was Jeffrey Epstein's partner in crime. So he's hired one of the most notorious criminal defendant lawyers
On a slim budget.
Yeah, somehow under $100,000 allegedly. Maybe he gave him the rest of his FTT holdings. Who knows?
I mean, the guy's a really good liar. There's a reason he got to where he got, and it's all kind of clear in hindsight, right? But as this goes on, and hopefully we get some good information from the testimonies in court and stuff. But I think we're gonna really realize that Sam Bankman-Fried's strengths were not how to run a company and stuff like that. It was more so on the back end, and you know his verbal communication skills, lying his way out of things. And I mean, you've already seen in some interviews that he's done with like the Wall Street Journal and Forbes. Like he's really good at manipulating the conversation or the narrative, and making you like forget about what you actually want to talk about. It's really crazy.
Right. Yeah, no, definitely some psychopathic traits. Definitely some psychopathic looks as well. Some crazy screenshots from those interviews circulating around.
I mean, while we're on the topic of FTX too, there's a little side story here that, Kevin O'Leary, who was the spokesperson for FTX, and I mean, he came out defending FTX when all this first happened. He's lost about 15 million due to the FTX scandal.
Well, he lost his 15 million payday.
Yeah, I mean, still, it hurts either way.
Sure,
But
sure. So, yeah, the Kevin O'Leary story goes on to say investor, Shark Tank judge, the CNBC contributor Kevin O'Leary said Thursday he's lost all of the $15 million FTX paid him to act as a spokesman for the now collapsed crypto exchange that some have called fraudulent. O'Leary and other celebrities such as Tom Brady and Larry David were sued by FTX investors who say the exchange's ambassadors should have done more due diligence and exercised a greater level of care before promoting the crypto empire. I think it's worth noting that all of these things that led to FTX's demise were happening behind closed doors, at least to my knowledge. So, no matter the level of due diligence that one could have done, I don't think predicting this was necessarily feasible, especially, for someone who's receiving a large payout. Of course, they want to dig into the company, make sure it's legit, but unless, you request that they be audited or something like that by a truly reputable firm. FTX had a good image, right? Like they had all of those ambassadors. They had that image. And yeah, I don't think really 99.9% of people would not have been able to uncover what was truly going on behind closed doors, right? Like all of those people that talked about the possibility of this happening was just based off of rumors. There was no cold hard evidence, at least to my knowledge, prior to the leak of the balance sheet.
yeah, that's actually a great point that I haven't heard brought up a lot in regards to these ambassadors that are, taking a lot of heat for what they did and what they promoted. But you're right. Unless the only way this could have came to light sooner would have been an insider working at FTX having access to the accounts and and the the books, leaking that. there's no other way to know, no matter what due diligence you could have possibly done. So there's a a level of unfairness as far as coming after these guys for promoting it, because from a surface level, everything did look pretty good.
Right. So getting on with the story here, the Canadian investor was grilled by CNBC's Squawk Box hosts over his failure to properly assess the risks associated with investing and promoting FTX. O'Leary said that he fell prey to groupthink and that none of his investment partners had lost money. Total deal was just under $15 million. All in, O'Leary said, I put about $9.7 million into crypto. I think that's what I lost. I don't know. It's all at zero.
Oof.
He also said that he had more than $1 million of FTX equity, now rendered worthless by the bankruptcy protection process. The balance of a little over $4 million was purportedly eaten up by taxation and agent fees, according to O'Leary. O'Leary promoted FTX aggressively on Twitter and online, touting his close connection with disgraced founder Sam Bankman-Fried, who is facing multiple investigations. When O'Leary first began to promote FTX, he said it was FTX's compliance systems that drew him in to invest in the crypto exchange. Finally, solved my compliance problems with the hashtag cryptocurrencies, O'Leary wrote on LinkedIn in an, a sense, deleted August 2021 tweet. Eventually, Delaware bankruptcy protection filings by new FTX CEO John Ray III would term FTX's risk, audit, and compliance procedures a complete failure of corporate controls. It was not a good investment, O'Leary said Thursday. What a wise closing statement from the man himself.
Hindsight is 2020, man.
Isn't it? Although I think a lot of us in the cryptocurrency markets can say that at this point in time.
Yes.
But, we're still very young as far as the cryptocurrency market. And I believe this to just be a temporary thing. Yeah, certainly if you bought cryptocurrency within the last 2 years, it's safe to say what O'Leary has said right here. Yeah, just an extreme example of the volatility in crypto. Or you know what? Sorry, it's far more than that. This is blatant fraud. And, hopefully we see some justice take action here.
Definitely. I mean, at the end of the day, these are just, or what they should be are just expensive learning lessons, right? So, hopefully people have, the ones that stick around, because you have to be very resilient to survive something like this and then continue in the crypto space or in crypto investing.
Mm-hmm.
But, as long as you have some takeaways from this and, you do better in the next run, then it was worth more than gold. But unfortunately, it is short-term pain that, people have to live through.
Totally. So we'll get on with our next story here. Just 8% of Americans have a positive view of cryptocurrencies now, CNBC survey finds. So after a series of crypto collapses, scandals, and bankruptcies, Americans' views on cryptocurrency have soured sharply, with the CNBC All-America Economic Survey finding a majority favoring strong regulation. The survey shows 43% of the public with a negative view of cryptocurrencies, up from 25% in March. The percentage with a positive view plummeted to just 8% from 19%, and those who are neutral fell almost in half to 18% from 31%. It's a dramatic fall for an investment that was touted as its own asset class and has a celebrated coming out party on the global stage with multiple Super Bowl ads and celebrity endorsements. That popularity attracted many ordinary Americans to crypto, and the survey shows 24% of the public invested in, traded, or used cryptocurrency in the past, up from 16% in March. And as I previously said on the last story we just talked about, most people that got into crypto the last year or two are definitely down on their investment. We're talking about the general American public and how they feel on crypto. The year of 2020 and 2021 was the year of crypto, right? We saw tons of tokens surging multiple X's in value. And naturally that brought lots of popularity, Super Bowl ads. Crypto was really thrusted into the mainstream spotlight. And at that same time, that was all-time high prices, so you get all of these everyday Americans buying in at the top, and now we are where we're at right now, far lower than the top, right? Who knows where the bottom is? Maybe this is the bottom, maybe it's not. Either way, most of the American public is down on their cryptocurrency investments. I don't think it's unreasonable to see this downfall in the public sentiment of cryptocurrency, especially with all of the negative news. But really, you also have to ask how many of those Americans really understand the technology.
Well, and so this plays into human psychology, because at the end of the day, the average person, and I'm talking about 90% of people, their sentiment is going to be tied directly to price or personal experience. So, most crypto investors, especially the normies that came in the last year or two, they bought the all-time high. They've been living through just disaster after disaster, top exchange collapses, stable coin that's supposed to be one-to-one collapses. And it's nothing more than just a complete shattering of, reality for these people, because that's what they came into, with those expectations. And it's just been one after the other. So if it's not because that they lost money due to all these hacks and mismanagement of funds and collapses, it's just because they bought Bitcoin at $65,000 and now it's trading at 17.
Right.
That would also lead you to not have a positive outlook. And most people at the end of the day can't really step back and see the bigger picture. And so this is more than justified, in my opinion. Does it mean that crypto's over? On the contrary, I think it only shows the future ahead, because of how the kind of people that were in crypto to bring this to 8% just goes to show you that the industry wasn't ready for that growth it experienced.
Mm-hmm.
And it's it's coming down to levels that are corrected for that, and we should start to see real legitimate players coming in and using this downtime to actually help the industry and build positive infrastructure.
100%. I mean, if you look at the .com bubble and the general public sentiment around that, people thought the web was dead.
Mm-hmm.
And now we have most of Americans spending absorbent amounts of time on the internet, right? Like, the internet plays a massive role in all of our lives. There's a huge internet industry, so many different technologies and capabilities that we have today would not be possible without the internet.
Mm-hmm. And if you ask people that were investors or were affected by the .com bubble burst back in the day, and if you could go back in time and tell them where we are at today with the internet, I bet you they would have thought you're a lunatic.
Right. Yeah. No. 100%. I think that's a important correlation to draw, is really researching the similarities between where we are at right now with that .com bubble burst. On the way up, people were theorizing it was going to be a similar situation. Of course, nobody wanted to admit that everything was pumping, times were good, but naturally markets come and go with their cycles. And yeah, you just have to understand the fundamentals behind what you are investing in. If you're just buying something because somebody told you to buy it, you should probably reevaluate your strategies. But we'll get on to our next story here, talking a little more about FTX. So the crypto collapse cost Taylor Swift a huge payday as well. FTX brought tons of huge celebrities on board, and the more recent ones, a lot of them are getting screwed over just because of the timing with the whole collapse. So when cryptocurrency exchange FTX raised $400 million from investors such as SoftBank, Temasek, Tiger Global, and others in January, its net worth took off. The funding lifted its value to $32 billion. By November, it was bankrupt. While FTX pumped up its reputation with big-name investors, it was also allying itself with high-profile celebrities such as Tom Brady, Shaquille O'Neal, Naomi Osaka, etc. And before its collapse, FTX reportedly was also hoping to form a partnership with pop and country music star Taylor Swift. FTX CEO Bankman-Fried was the institutional face of the cryptocurrency industry. He amassed a net worth of more than $21 billion, but lost most of it in a short few days beginning November 8th. So getting on with the Taylor Swift part here, on December 7th, it was revealed that FTX had been negotiating a $100 million sponsorship deal in spring of 2022 with pop and country music star Taylor Swift. The deal was in its late stages, reported the Financial Times, citing people with knowledge of the talks. Several members of FTX's marketing team were opposed to the deal, the publication wrote, believing it was too high of a price to pay. They also questioned the value of celebrity endorsements and whether Swift was an appropriate partner for its customers' demographics, the story said. One former FTX employee said the company saw a light degree of endorsement from Swift on social media, but another person said Swift never said she would endorse the company. Taylor would not and did not agree to an endorsement deal. The discussion was around a potential tour sponsorship that did not happen, the person told FT. Since the negotiations did not result in a deal, Taylor is free from any tough public relation discussions about ties to the company, which has been denounced for its celebrity and notoriety-driven approach to promoting its currency. So, Taylor really dodged a bullet here. $100 million is a goddamn lot of money. And yeah, I think that just goes to show, they were really just pumping their reputation, right? And along with that, pumps their valuation. It's really weird how that works, right? You can just bend the minds of the public into, trusting you, and actually that enhances your reputation, enhances your customer base, meanwhile being fundamentally screwed.
Yeah, just the whole scenario around this is, and it goes to show you, right, the exchanges that are having, the biggest struggles right now are the ones that, spend all this money buying stadium names, getting huge Super Bowl ads, hiring all these, celebrity listers, influencers. What they were essentially doing is, rather than focusing on the customer and also building value, they were looking to just appease investors, by pumping their valuation. So that's all this really was.
100%. We are witnessing the fallout of this in real time. We'll get on with our next story here. So, did SBF finally admit the obvious in exchange with YouTuber CoffeeZilla, who I'm sure most of you know? Very cool guy. Kind of the vigilante of the crypto space, if you will. Anyways, in an exchange with YouTuber CoffeeZilla, the former CEOs disclosed that client funds weren't segregated as promised. So Wednesday, CoffeeZilla, a YouTuber with a rising star who has made a career of shining a light on sketchy projects in and out of crypto, pressed Bankman-Fried for information related to how different customer accounts were treated at the exchange. It turns out there wasn't much differentiation. At the very least, during the final days, the exchange was in business, Bankman-Fried admitted. At the time, we wanted to treat customers equally, SBF said during a Twitter Spaces event. That effectively meant that there was, if you want to put it this way, like fungibly created between the exchange of spot and derivatives business lines. For CoffeeZilla, this looks like a smoking gun that fraud was committed. So at the very least, this is a contradiction of what Bankman-Fried has said just minutes before when first asked about the exchange's terms of service. I do think we're treating them differently, Bankman-Fried said, referring to customer assets used for margin versus staking versus spot versus futures collateral. All of those services come with different levels of risk, different promises made to customers, and different responsibilities for the exchange. According to FTX's terms of service, everyday users just looking to buy or store their cryptocurrencies on the exchange could trust they were doing just that, buying and storing cryptographically unique digital assets. But now, thanks to skillful questioning by CoffeeZilla, we know that there was instead omnibus wallets, and spot derivatives traders were essentially assuming the same level of risk. We can also assume this was the long-standing practice at FTX. Bankman-Fried noted that during the run on the exchange, when people were attempting to get their assets off before withdrawals were shut down, FTX allowed generalized withdrawals from these omnibus wallets. But he also deflected, saying, "What? You wanted us to code up an entirely new process during a liquidity crisis?" Before now, Bankman-Fried has been asked multiple times about the exchange's terms of service and often managed to derail the conversation. He would often point to other sections of the document that stated clients using margin could have their funds used by the exchange. Or he would bring up a vestigial wire process in place before FTX had banking relationships. Apparently, according to SBF, customers had sent money to Alameda to fund accounts on FTX, and somewhere along the lines, this capital ended up in a rarely seen sub-account. This also had the benefit of inflating Alameda's books, another dark corner of the empire. Questions remain. We still don't know how or when Alameda lost money, and how much of that could have been client funds. According to recent reporting, Alameda had an unclosable leverage account on FTX, almost by definition, if it was in the red and in debt. And if there was a wallet that commingled funds, Alameda was also partially funded by some FTX customers without their knowledge or consent. There would be a chargeable fraud case if spot assets weren't backed one-to-one as promised or were used as collateral for loans or other purposes, Renato Mariotti, a former federal prosecutor, told CNBC. Bankman-Fried has said previously that dollars on the exchange and hedge fund were generally fungible, being used to reportedly fund personal loans to employees and make venture deals. Now, too, did he admit client funds were effectively interchanged, at least in the final hours? So, I think really, what CoffeeZilla got SBF to partially admit to, is the only applicable option here. There were plenty of spot positions that people were locked into. And if spot positions were backed one-to-one, just like the terms of service said, those spot positions should have always been redeemable, even if, the derivatives part of the exchange was insolvent. The spot positions should have always been redeemable. And just the fact that those were not redeemable when the bank run happened and the exchange became insolvent, I just think it's obvious that they were not backed one-to-one as stated in the terms of service.
So it's a small win because, and I highly recommend you guys go watch CoffeeZilla's video because he breaks it down really easily there. But essentially, when you sign up to FTX, there's 2 terms of service agreement, and for user A who is just simply holding his Bitcoin on FTX, or he just wants to buy and sell Ethereum and just keep his assets on FTX rather than getting a cold wallet storage like we always recommend on here, then that user's assets should have never left FTX. It shouldn't have been used to cover somebody else's funds or margin trades, or it shouldn't have been touchable by anybody. It should have stayed with FTX. So that was in the terms of service. And essentially what CoffeeZilla got Sam to admit is that there was no differentiation between the normal user and then the users who were opting into lending, staking, margin trading, leverage trading, which are all things that you can go over your balance. And so essentially your balance has to be used as collateral for the debts you accrue. And so there was no differentiation between user A or user B. It was just a pool of money. And at that point, it's, at the very least, it's a small win that shows that Sam Bankman-Fried violated terms of service for a majority of his customers.
100%. Those terms of service are legally binding. So, we'll see if SBF just continues to say he doesn't know what happened. And we'll see if Probs can uncover what truly happened. But I think the proof is in the pudding, right? Like, people had spot positions, they couldn't withdraw. And, really that's the end of the story.
Yeah, it's open and shut case as far as that goes. Now, proving the rest of it with Alameda and everything else, that's a whole different battle. But nonetheless, at this point, it's safe to say they can at least get him on this count.
Totally. So we'll get on to our next story here, kind of bringing back the whole Celcius thing, which was really one of the first major platforms to become insolvent. So bankruptcy judge orders $44 million in crypto to be returned to Celcius customers. Maybe they can raise that by selling those unbankrupt yourself t-shirts that they started selling post-bankruptcy. Quite the insult to injury. But anyways, according to Bloomberg, the order was delivered by United States bankruptcy judge Martin Glenn verbally at a December 7th hearing, with the judge noting, "I want this case to move forward. I want creditors to recover as much as they possibly can, as soon as they possibly can." The order only involves crypto held in custodial accounts, and the $44 million is a tiny fraction of the billions Celcius owes creditors. The order comes after an agreement was reached between Celcius advisors and stakeholders that crypto deposited in custody accounts belong to its users and not the platform. It is important to note that this order only applies to pure custody assets, those that have never touched Celcius's earn accounts and have only ever been held in the custody program. Celcius held over $210 million in custody accounts as of August 29th, but only $44 million of that fit with the latest order's criteria. I think this ruling applies to what we just talked about with the whole terms of service within FTX. It's really just the lines between what you are using the platform for, right? So if you're using Celcius to borrow things like that, where I'm sure in the terms of service, they note that your funds are not being custodied one-to-one, and that the exchange may use your funds elsewhere. But it seems like this judge is ruling that Celcius must uphold their one-to-one spot, if you will, positions, right? Because that's essentially what custody is. It's having this platform hold your crypto for you. It's not using your crypto to gain yield. It's not using your crypto for leverage. It's none of that. It's just simply holding your crypto.
Yeah, it's a very similar situation to what we just spoke about FTX. I'm really glad that the judge settled on, allocating this to the customers, because ultimately, in this kind of bankruptcy situation, it can go to all the accredited investors that would lose money as well. So it's nice to see that it's going to the average Joe that might have lost some money. It's not a full one-to-one, because it was like 250 million versus 44, so it's
Right.
It's definitely a fraction, but it's still something.
For sure. Well, on the other hand, Celcius's earn accounts, which enabled depositors to earn interest, are where the majority of the $4.7 billion in user funds are currently locked up. So, see, 40 million is about 44 million is just below 10% of 4.7 billion. I know if I had my funds on Celcius, chances are I would put them in the earn account just to earn interest on that, but you got to read the fine print, right? Because even in a case where, the platform goes bankrupt, there are things you can still do to protect yourself. But that kind of sums up this story, so we'll go ahead and get on with our last story here. So, developer of popular MetaMask wallet reduces consumer data retention to 7 days after backlash from community. So if you didn't hear about this, there was some confusion, misrepresentation, and concern about the data that MetaMask and the node provider, I think it's Infura, that MetaMask defaultly uses, essentially logging all IPs for every transaction made. So if you make a transaction out of a MetaMask wallet, the company behind the node is logging your IP, allegedly, but we'll dig into the story and hear more about it. So, Consensus, the developer of the popular crypto wallet MetaMask, has reduced the retention of MetaMask user data to 7 days following massive community backlash. In a recent blog post, the company announced its data retention update, reducing the amount of time it will keep user data, such as wallet addresses and IP addresses, to 7 days. As reported, Consensus updated its privacy policy in late November, revealing that it will start collecting certain user-provided data, such as identity information, profile information, contact, financial, and transaction information, among others. Consensus also revealed that its other product, Infura, collects users' IP addresses whenever they send a transaction. As a remote procedure call (RPC) provider, Infura is a critical cog in the Web3 infrastructure because it connects the wallet to smart contracts on a blockchain. I remember a couple months ago, Infura was down very shortly, and people thought that Ethereum was broken, right? Because Infura is such a huge node provider. It's the default for MetaMask. It's the default for a lot of crypto softwares, and so if that node infrastructure is temporarily offline, to the average user, it seems like the blockchain is just broken, right? Now there's alternatives that you can use and that were online, but the majority of people don't understand that, right? So to the average person, it seemed like the blockchain just ceased to work for a little bit. Anyways, it shortly went back online and all was fine. But, I think that this whole data collection bit really goes against everything that DeFi goes for. Sure, we are heading into an era of regulation, and chances are things like this will become necessary.
The norm. It's necessary, and it's also going to be the norm, like it or not, because it's one of those things, like in a situation where you have a hacker who steals a lot of funds. At least now you have an IP address logged to that wallet, that can kind of be used to track them down.
Right. Yeah. So, kind of getting on with the story here, it says we retain and delete user data such as IP addresses and wallet addresses pursuant to our data retention policy. Consensus said we are working on narrowing retention to 7 days, and we will append these retention policies to our privacy policy in an upcoming update. So, I'm curious if that just means they're not custodying that data, if they're handing it off to someone else and then deleting it from their books, or if they're truly wiping that data.
I can't imagine, and I'm glad you thought of that. I can't imagine that they're going to go to the trouble of collecting that data and then hard deleting. There's no way. So I'm sure it's probably very similar to what your theory is, that they probably just did it off to a different company.
100%. I don't know. I'm sure we'll see more about it. So here's a quote from them. So we have never and will never sell any user data we collect. We use data strictly in adherence with the limitations described in our privacy policy. Furthermore, Consensus said it aims to build a new advanced setting page to give all new users the opportunity to choose their own RPC during onboarding and thereafter due to the community backlash. Users have the option to opt out of Infura and choose a third-party RPC. So that's also something worth noting. If you do not want Infura collecting your information, you can always use a different RPC and node provider. There are so many options out there. Just Google an RPC for whichever network you want to use, and you will see that there's a plethora of other options out there. Infura is surely the biggest just because of how big MetaMask is, and Infura is the default. But there are other options. But that about wraps up this week's Crypto Club. We hope you enjoyed, a lot of FTX, a lot of SBF, a lot of sticky situations. We keep saying this week after week, but hopefully things don't get much worse. We'll just have to see, sitting around $1,200. And we will see where we are at next week. Thank you, everyone, for tuning in. This has been the CoinScan team, and we will see you shortly.